Joining us now to talk about the markets and some stories that are out there is Chris Kerlow, Senior Portfolio Manager at Canaccord Genuity's Team LWC. Thanks for coming in, Chris.
Thanks for having me, Paul.
There's lots to talk about. Let's talk about Jerome Powell hammering forward that message. Now he's in Spain saying the same thing that he said to U.S. lawmakers last week, and that is that you can count on two rate hikes before the Fed is done dealing with inflation.
Yeah, I caught the transcript this morning as it happened overnight in our time, but he said the majority of FOMC members believe they'll need two more rate hikes this year. That was probably reinforced with the strong GDP data we saw this morning, revised up to 2%. Payroll data, the weekly indicator, kind of missing expectations is a bullish thing, less people filing for unemployment. I think, and surprising, the markets are taking good news as good news, taking it in stride slightly higher today.
And we've also got news in the banking sector. A couple of banks have gone to the Fed, their chief regulator, and said, are we in shape to raise our dividends? In other words, they've passed those stress tests that are a fact of life for big U.S. financial institutions. Yeah,
this is the annual stress test that they go through every year. A lot of the banks did much better than expected, which certainly opens the door for a variety of dividend hikes across the sector. We really like the U.S. banking sector. We added a position in ZUB, which is an equal weight banking CAD hedged ETF to get further exposure in the LWC model portfolios. That CAD hedge has also worked out well this year, or actually this month, following the surprise rate hike from the BOC. You know, we're seeing a year-to-date high nearly on the CAD. And the banks are a beneficiary of being able to, give money back to shareholders, which is great for, people that own those stocks.
And we're really seeing a reaction, aren't we, in the U.S. banks today? We just cycled through a number of them. I think a number of those haven't yet got to the passing the stress test stage, but the judgment of investors this morning is that as a group, the stocks look attractive.
Yeah, totally. We added to that position following the SVB regional banking crisis. We didn't see that as a systemic risk. The large money center banks in the U.S. were kind of thrown out with the baby in the bathwater, in our opinion, and still trading at reasonable levels with high loan loss provisions. If this recession, does hit us, we think it's going to be shallower and less than expected. And so as those loan loss provisions roll off, earnings should benefit from that.
How do you view the U.S. banks and their appeal to investors versus the Canadian banks?
We're owners of banks on both sides of the border. The Canadian banks, with the U.S. exposure, TD, BMO specifically, have lagged the Canadian domiciled national RBC counterparts. We're owners of TD and BNS and the LWC Canadian High Dividend portfolio. Same story there. These banks are trading at recessionary levels, large loan loss provisions. Looking at it from a 15-year price to book, price to earnings, you're kind of at the bottom of that trading range. So, could things go lower? Obviously, always, but we think that it's an asymmetrical return profile from here. And you look out 3 or 4 years, I think people look back at a good buying opportunity. You
mentioned that you bought the CAD hedged version of that ETF. That's a Canadian dollar hedged version of ZUB. That's a BMO ETF that holds shares of the U.S. banks. It's available in an unhedged version as well to investors. Tell us why you've chosen the hedged version.
That's just from an overall portfolio currency exposure. We kind of have been making that hedged move coming into the year. We did that on some of our global equities at the start of the year, and again once here. A bit fortuitous bounce following that rate hike, but the global reserve currency, the U.S. dollar, is down to 59% market share from 71% about 2 decades ago. Commodities have obviously troughed, so we think we're bullish on the materials sector, and that could lead to another leg higher on the Canadian dollar. And then, the petrodollar is now, we're seeing other currencies settling, commodity trades, particularly in natural gas and oil. That's kind of the first time that's happened. And so we're kind of bullish on currencies outside of the U.S.
You say commodities have troughed. Do you see higher, for instance, copper prices and oil prices in the second half of this year?
It's a short time horizon. If we move into, negative economic data, that's not going to be good for those economically cyclical commodities that you've mentioned. But a lot of the gains on inflation have really been from this commodity complex trading lower. You look back a year ago today, oil was $110, it's $70. Nat gas was $6, it's below $3. Copper, wheat, corn, all kind of in a lower trading range than they were a year ago. And that's really not the type of inflation I think Jerome Powell and the Bank of Canada are looking to ease. Obviously, that flows through the economy as a feedstock in much that we consume, but it's that services inflation that's remained sticky, and we've seen a massive move higher on economic surprises both in Canada and the United States, which I think kind of gives the Fed and the Bank of Canada the ability to maybe do a few more rate hikes here.
What are your thoughts on the tech stocks, which have led the market higher this year, at least a small group of those mega cap techs?
Yeah, we've been trimming our exposure specifically in NVIDIA and Uber. Still have positions in the names, but have been taking profits along the way. Clearly, that's led the market higher. If you look at the equal weight S&P 500, it's recovered, but not nearly as much. But a lot of people think that this is a bear market rally. We're getting close to that Fibonacci band on the equal weight index, and I think if we pass that, which is about roughly 2/3 of the retracement of the pullback, it's hard to call this a bear market rally, pardon me, and possibly the start of a new bull market. We think there's probably more risk still being out of the market, but active management, active security selection is something we're tilting clients towards, and repositioning our portfolios from a more passive tilt back in 2022.
Explain briefly that Fibonacci band, that threshold that the markets are getting close to.
Yeah, so this is the golden ratio that my good friend Derek from Purpose would always be talking about in our investment committee meetings, but these are kind of things that happen in the world naturally, and just key technical indicators that something we keep an eye on.
Okay, Chris.